Welcome to The Explainer. Today, we're diving into a genuinely fascinating financial journey. We are going to unpack exactly how Anshul Saigal went from being a standard, salaried employee all the way to an ultra-high net worth individual who actually manages his own family office. And you know what the most incredible part is? He built the whole shebang entirely from the ground up, starting from absolute zero.
Okay, let's dive into this. Because look, it is so easy to just assume that extreme, family office level wealth only comes from massive inheritance or, pure blind luck. But as you'll see today, for a salaried employee to pull this off, it requires an active, highly specific behavioral framework. It's actually not about how much you earn, it's about a radical fundamental shift in how you think about your capital.
So, here is our roadmap for today. First, we'll look at the mindset of ultra wealth. Then, we'll cover exploiting maximum pessimism, avoiding the hype trap, discovering your true investing edge, and finally, the bull case for India. We are going to completely demystify the mental models of the top 2%. Section 1. The mindset of ultra wealth, the 98% versus the 2%.
Right off the bat, there is a massive foundational difference in how average folks and the ultra-wealthy perceive risk. 98%. That huge number represents the vast majority of people who, as Saigal notes, actually lack the innate desire to be truly phenomenally rich. Now, I know that sounds crazy, right? But it's true, because their primary, overwhelming desire is just to be safe. They're deeply attached to the money they already have, and honestly, the mere thought of losing even a tiny fraction of it is just paralyzing.
And this brings us to the crucial shift: safe capital versus risk capital. Most people just flock to fixed deposits yielding 6 to 7% because, well, it guarantees safety, even if taxes and inflation completely eat up those gains. But to break out of that salaried rut, you absolutely need a different kind of stomach. Seidel emphasizes that having the psychological fortitude to take risks and being genuinely okay with potentially losing capital and equities is exactly what unlocks those massive 20x to 30x multi-bagger returns over a 4 to 5 year cycle. Basically, extreme wealth just doesn't exist without risking capital.
Section 2. Exploiting maximum pessimism, the 2008 case study.
So, to see what this extreme risk appetite actually looks like in the real world, especially when market conditions are just absolutely terrifying, let's look at this intense timeline from 2008. In August of that year, Saigal suffered a massive personal tragedy when his sister passed away suddenly. Then, fast forward just a few weeks to September and October, and the Lehman Brothers crisis triggers a total global financial meltdown. I mean, the Sensex is dropping 6 to 7% every single day, and broader market stocks are just collapsing by 20 to 30% daily. But looking beyond his immense personal grief and the absolute panic in the market, he reasoned that, look, either the world is literally ending or this is the absolute bottom. So in October 2008, he actually took out a loan against his salary to invest. And wow, by early 2010, that terrifying leap of faith yielded 7 to 8 times his money.
Section 3. Avoiding the hype trap. Navigating market bubbles. Now, navigating market bubbles is just as absolutely crucial as buying during crashes. Let's move to the other end of the spectrum and see how this builds when the market is overly enthusiastic. To really understand a bubble, you have to break down the anatomy of a stock price into two parts. On one side, you've got earnings. This is the cold, hard reality of how the business is actually doing. On the other side, you have the price-to-earnings ratio, or PE. That is purely the market's perception of the future. Think back to the tech boom right after COVID. We saw stock prices absolutely explode, going up 5, 6, 7 times in value, but the actual earnings, they maybe only rose 50%. The entire rest of that massive price explosion was just multiple expansion, meaning the market's perception of the future had completely detached from reality.
Let's put that danger into perspective visually. Imagine a stock with a historical average of a 10x PE ratio. Suddenly, because everyone's hyping it up, it's trading at a massive 35x PE premium. When you buy at 35x, you aren't just buying a good company anymore. You are betting heavily that its future growth will be absolutely 100% perfect. And here's the kicker. If the market expects 40% growth and they only deliver 35%, that tiny little disappointment can cause the stock to plummet 30 to 50%. The real trick here is recognizing when your own psychology is getting swept up in the recent success of a hyped-up sector.
And this brilliantly illustrates how Saigal applies this exact philosophy today. Notice how he's completely avoiding the current AI bubble and those US Magnificent 7 tech stocks. Why? Well, because they're incredibly expensive, fully priced, and massively overowned. The frenzy is already baked into the price. Instead, he's looking at brick-and-mortar or consumer discretionary businesses. Capital has essentially fled these areas, which leaves them reasonably valued and heavily underowned. He simply refuses to subscribe to that buy-at-any-price mentality just because the sector happens to be popular right now.
Section 4. Your true investing edge. Behavior over data.
So what does this all mean for us? How does a single retail investor actually beat the market today when all the big institutional buyers have access to the exact same internet, the same data, and the same AI tools? Well, there are really only 3 potential types of edges out there. Number 1 is insider information, but relying on this is super risky, it's mostly illegal, and honestly, it leaves you with a deeply flawed process where you're just sitting around waiting for a hot tip. Number 2 is better data analysis, but this is incredibly difficult because the seller on the other side of your trade is literally looking at the exact same data and is probably just as smart as you are. So what's left? Number 3, a behavioral edge. Your ability to maintain discipline, detach yourself emotionally from your money, and control your own psychological biases, that is the only truly durable differentiator you have.
To build that behavioral edge, Siegel relies really heavily on a powerful mental model: invert, always invert. This was famously championed by the late great Charlie Munger, drawing on principles from the mathematician Carl Friedrich Gauss, and the concept is just fascinating. Basically, the absolute best way to prove that your investment hypothesis is correct is to first assume that you're wrong, and then actively argue against yourself.
Putting inversion into practice is actually a pretty straightforward step-by-step process. Step 1, you form your investment hypothesis. Step 2, you hit pause, flip your thinking completely, and ask, okay, what could go wrong here? And Step 3, you list out all those negatives and attempt to serially negate them. If you can successfully knock down all the counterarguments, your original thesis holds strong. This is literally your best defense mechanism against innate human flaws like social proof, that herd mentality of just doing what everyone else is doing, and recency bias.
I love this next story because it perfectly shows behavior triumphing over data. Siegel had this rock-solid, incredibly well-researched thesis on an optical fiber company. He took this exact same data and presented it to 2 of his very smart investor friends. But his friends were completely caught up in their own dogma. They suffered from a massive bias against cyclical industries, only seeing the historical boom and bust nature of the sector. Because of that, they totally missed what Siegel saw, which was that the industry was actually at a cyclical low with massive upside potential. Because they didn't check their bias, they passed on the opportunity, completely missing out on a stock that ended up tripling in value in just 2 months.
Section 5. The bull case for India. Our macro thesis.
All right, taking everything we've just learned about risk appetite, avoiding hype, and utilizing a behavioral edge, where is this ultra-wealth framework actually being deployed today? 100%. Siegel describes himself as being bullish out of his head on India, keeping essentially 100% of his entire portfolio in Indian equities. He is completely bypassing global geographical diversification. His conviction here is crystal clear. If you're investing today and you aren't bullish on India, you are doing yourself a massive disservice.
Now, what's really interesting about this slide is the sheer scale of the turnaround that's fueling this incredible conviction. Siegel points out that, think about it, roughly 12 years ago, it was virtually impossible to even find a manufacturer in India capable of building basic office furniture. I mean, they literally had to import it from Malaysia. Contrast that stark reality with where we are today. India is now manufacturing and exporting nearly 40% of the entire U.S. smartphone requirement. That economic transformation from zero manufacturing scale to a high-tech global exporter is just a night-and-day shift. But hey, staying true to our invert, always invert philosophy, we have to objectively look at the risks, right? According to the source material, the single major variable that could potentially disrupt this macro thesis is the risk of India shooting itself in the foot via unexpected political shifts. Specifically, we're talking about a potential shift in policy direction following the upcoming 2029 elections. However, the data strongly suggests that steady policy continuity is the core foundation that's currently holding up this massive growth trajectory.
And that brings us to the end of our explainer. We've seen how going from absolute zero to ultra wealth isn't about just hoarding your salary in a fixed deposit. It is about aggressively taking risks during peak market pessimism. It's about dodging the euphoric hype of overowned stocks and maintaining a relentless behavioral discipline to question your own assumptions. So I'm going to leave you with this final thought. If true wealth requires doing the exact opposite of what 98% of people do you have the stomach to invert your own financial biases starting today?